Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Vik Sasi of Dreamers VC. Vik, thank you for joining us.
Thanks for having me, Paul.
So what was your background before investing in early stage companies? What did you do before this?
Yeah, so I have a pretty non-traditional path. Straight out of college, I actually worked in international development and kind of nonprofits. Spent about 1.5 years in East Africa, about 3.5 years in Haiti, working with the Clinton Foundation and the government down there. And then I ended up getting my MBA and then transitioning into venture. So didn't know what a balance sheet was 4 or 5 years ago, but very happy to say that I certainly do now.
Well, great. So what excites you right now?
Candidly, a little bit of everything. In terms of some of the spaces that we're particularly focused on, you're seeing a lot of the evolution of marketplaces. I think given what's going on in digital media, there are lots of new business models that are coming in the entertainment space. I think the rise of games. I think Andreessen Horowitz has this saying called "come for the game, stay for the party." You're seeing a total transformation of real estate, and then even just passion economy and even just emergence of new business models, things like Substack with newsletters, podcasts like the one we're on right now. Those are the things that really get me excited.
Well, great. Well, for those investors out there, what's your advice for them about investing in startups? What do you advise them to do before they write that first check?
So, yeah, I mean, it's everyone has their own separate diligence process to run, and I'm not going to go through what ours is because I'm sure it's very similar to a lot of others. But just one thing, from very high level, Peter Thiel has his advice to really, achieve massive success. You have to be contrarian and be right. But and that does certainly ring true. Except now every investor is trying to differentiate themselves and really sort of think like, oh, we're going to bet on this because this is contrarian, and so I would just really rely on your fundamentals. On your fundamental business sort of metrics, the things that you're really searching for, or especially if they're things that your LPs want. But ultimately, it's like, trust your gut at the early stage. It's like team, product, market. Don't try and stray from that too much. And then also it's like, try not to succumb to the echo chamber of everyone after the WeWork debacle. Everyone's now focused on profitability, and as well they should have been. But Mark Suster has this quote that it's like, don't lose sight that like venture is still about betting on these founders that sound, crazy initially. And so, Mark Suster from Upfront has a thing. If I'm not making you slightly uncomfortable when I'm writing my first check, I'm not really doing my job. Our job is to fund things that aren't obvious, that other people aren't doing today. And so everything that you're looking at really should be kind of head scratchers. And so you're going to get some, if not most, wrong, but it's all about the ones that you get right. So those are things that I'd probably advise.
Great. So for the other side of the table, what do you tell startup CEOs before they launch that company to do before they actually kick it off?
Very similar is try as hard as you can to not fall prey to the echo chamber of, if you're in the Bay, keeping up with the Joneses when you see these massive funding rounds, or when you see that this other company that you were maybe competitive with got a term sheet from a top tier fund. Stay away from VC Twitter and really just try not mimic what everybody else is doing and what the latest trends are in YC. That's one. Number two, I think, is just understand that luck plays an outsized role in most, but not all outcomes in venture and in sort of the tech world. And the last thing is, I think, just this is going to be like one of the most emotional roller coasters that you're likely to ever embark on. And so just try and stay grounded however you can. This is why there are a lot of these executive coaches that have really sprung up, and just be humble above all. It's like, if you need to take the call, you're probably going to get a lot of cold emails from associates at venture funds. And so take the call if you can. And if you can't, don't try and big league them, but just pass them on to a colleague. And at the same time, while you should be, heads down, hiring, managing, you're going to get invited to a lot of speaking opportunities at conferences, and really try and take advantage of that time away from your team and line up other meetings, biz dev opportunities, whatever you can. And if you can't, then send someone in your stead. It's not worth gaining a little bit more brand promotion and company awareness than it is being in the office with all the other folks that are getting their their sweat equity. So yeah, that's kind of how we currently advise our portfolio companies.
Well, that's good advice. Well, let's talk about the state of investing in startups. So how is the industry evolving? What changes do you see coming up?
Yeah, so given where 2019 landed and even what again, I'm sure WeWork has probably been one of the most mentioned words on this podcast and just in venture, and especially given what's going on with the SoftBank Vision Fund. In terms of how the industry is evolving, I think early and later stage venture markets are really merging. And I think that was catalyzed by the Vision Fund, actually, because it basically created this barbell effect where the traditional Series B or like growth equity Series C to later had to sort of move a little more upstream because Vision Fund is sort of hanging over their head, about to drop at least $100 million check. And then that caused all of the traditional Series A folks to start moving to seed, and seed is now moving to pre-seed. And so, and especially even with the later stage folks, like how the big asset managers like Fidelity, T. Rowe Price would do, only pre-IPO. Now they started doing the later stage, usually the 1 or 2 rounds before a company goes public. And so, we even have hedge funds and like some non-traditional investors coming in and playing in venture. So ultimately, we do think that early and later stage venture markets will merge. And especially another thing that we really predict is going to happen, and you can already kind of see this with the equities and shares posts, is the secondary liquidity and public-private markets will essentially start to merge. And so we think Carta is likely to potentially open up the secondary exchange, given they have most startups are already using them for their cap table management and equity and share distribution. And so you have all of the, tons of employees, let's use Airbnb as an example, they're worth a lot of money on paper, but they can't access it. And so while there have been some interesting financial instruments created by the big banks to provide liquidity for some of these folks, we think immediate secondary liquidity will be really interesting and will totally change the dynamic both for startup employees and investors. And finally, and this is no surprise, we think assets will continue to move into and stay longer in the private markets as they can really recreate and avoid. They can recreate the same amount of access to capital while decreasing some of the more onerous regulatory compliance and just general market forces that you're just not as exposed to.
Well, great. Well, let's talk about your fund. So what's your investment thesis for your fund?
Yeah, so Dream is actually pretty interesting. We have our own views on a lot of different spaces, but in terms of our investment thesis, we're actually more of a purely opportunistic fund. And the other side of the spectrum, there are some funds that create spaces, themes, sectors, and they sort of form their own perspective on where it's going in the next 5 to 7 years or 10 years. And then they go and find companies and source according to that. And so we are literally in the opposite end of the spectrum where nearly 100% of our deal flow is all inbound. And we're just ultimately trying to select for a few things. First and foremost is a founding team we believe in. Secondly is kind of this up and to the right user growth or just engagement, preferably organic, just given that, there's some crazy statistics that 30 to 40% of venture dollars end up trickling down to Google and Facebook for ads. Number 3 is a potential for uncapped upside if it works. And so basically just saying like no ceiling, huge market with a lot of sort of adjacent opportunities. Number 4 is hopefully they'll have figured out that business model, or if they're pre-revenue, they have a compelling monetization opportunity. Number 5 is compelling theory on defensibility. What is their moat essentially going to be, or what could it be? And number 6 is just ideally capital light, but it's obviously everyone wishes these businesses are capital light so they can get the 10x return. But yeah, those are some of the things that we're always on the hunt for.
Can you talk about a particular startup that fits that thesis?
Yeah, certainly all of the hits, despite their public market debuts. I mean, I don't want to be the umpteenth person to mention Uber and Airbnb, but a lot of them certainly fit all 6 of those. In our current portfolio, we have a couple different, we have a number of different opportunities, a number of different examples. One we really like, and going back to the evolution of marketplaces, is a company called HipCamp, which is essentially the Airbnb of camping. They checked all 6 of those boxes. It's really strong organic growth. They figured out their business model, capital light, great founding team. We have investments in some of Elon Musk's companies, Neuralink and the Boring Company. The Boring Company in particular is really, really interesting. It doesn't check all 6 of those boxes, but in terms of potential for uncapped upside, I mean, we're talking about redefining how we move about in major cities. So yeah, so I think those 2 were kind of just no-brainers when we were presented with the opportunity to invest.
So you see a lot of startups out there. What are the challenges startups face in launching their business today? Is it regulatory? Is it the market? Is it technical? Where do you see them struggling most?
I actually think, and I'm really trying to hammer home this, like the amount of noise on things like VC Twitter and really just getting caught up in trying to mimic what's going on in YC or hearing about like the scuttlebutt that happens that gets passed around in San Francisco. One startup founder said this and he got a term sheet from Sequoia or something. And so I hear about it from some of the founders that we funded and just in our pitch meetings. And really, it's like just stay in your lane, run your own race, try not to get caught up in trying to keep up with the Joneses. That's sort of just like a market sentiment. That said, outside of regulatory, but just I think the power of the incumbents is greater than it's ever really been. And tech is certainly a pretty young and still immature industry. But I mean, you look at the FANG companies. They have hundreds of billions of dollars in their balance sheets. Despite this quote unquote tech lash, their market caps continue to reach new highs. And honestly, even when you see their CEOs go to Washington and get like quote unquote grilled, these politicians really don't even understand the business models of some of these massive, some of the largest companies on the planet. And so, given that, and unless there's some serious antitrust issues, and we'll see what happens in November of this year, I think it actually, the squeeze really comes down to the startups. And so it's a question that I hate asking, but I kind of have to when it's like, well, why couldn't, if you're going to compete with Gmail, like what's going to stop them from just throwing money and smart engineers the problem? And so ultimately the power of incumbent. And then finally, I think this tech lash actually will, I don't think it's going to be as bad as people make it out to be, but I think it's going to exist for a lot longer than people think. And so, and that translates into a number of different ways. And to just hiring might go down from a lot of young grads that are coming out of their schools. Before it was like, oh, we're going to go into investment banking and follow that route into private equity or go to McKinsey and do consulting. Yeah. So the last thing I think I'm just going to say is I think hiring challenge for the startup and the investors that just given all the scrutiny that tech has been facing, I think it's really going to impact the amount of talent that's coming into the sector. And so it's more of a long-term problem, but it's certainly something that people should be aware of. And the others, and a very adjacent sort of issue is just the rising cost of San Francisco. And so hopefully, not to keep mentioning Peter Thiel, but he said way back a couple of years ago, like the next big company will be built within a mile's radius of Google, and then it ended up being Facebook. And so now he's basically guaranteeing the next several $100 billion company will definitely not be in the Bay. And so I think that's pretty prescient talk.
Interesting to see how that's playing out. So you see a lot of applications out there. Where do you think the next what are good media opportunities for investors to pursue based on what you're seeing there?
Yeah, we're very bullish on gaming. And there was Matthew Ball who recently wrote just this absolutely epic piece about how, which we were very much aligned with and made a couple bets in, is that basically, the most dominant attention medium for last few decades has been television, and it's basically peaked. And so you're now seeing a lot of consumers' time being redistributed, and gaming is basically taking that same playbook and replicating the TV package. So there's an abundance of content in terms of both console gaming, like with the PlayStation, you can play online using Steam, or even like cloud gaming, like with Google Stadia, just an abundance of content in both volume and variety. The ease of access is great. So just as TV was everywhere and its content was basically universally accessible, you could also, go to a bar or your friend's house and you're right there. You're always surrounded by a TV, and the same thing is true with phones. And so mobile gaming is growing like gangbusters. There's basically frictionless content discovery, so many different use cases and functions. So ultimately, we really do think gaming is achieving, kind of like a cultural tipping point, and it's slowly starting to seep its way into, dominate pop culture. We saw with Pokemon Go. So I think there's just an incredible amount of competition that's always going to drive more value and innovation in the space. The second, I'm going to actually mention crypto. So obviously 2019 and the end of 18 saw this, the total rug get pulled out from under the industry. But, ultimately, I think we're kind of after that trough of disillusionment, we're in that second wave. And so you're really starting to see some really interesting companies come out, and even the ones that were very well funded, who have been heads down for the past 12 to 18 months, are finally, shipping product, and it's great to see. And now it's up to is the consumer interest actually there? And then finally, I think fintech is just an incredibly exciting place to be playing in. Visa just bought Plaid. I mean, this is just lighting up the space. There have been a number of different exits, which most recently, of course, is this one, and Plaid being, sort of like the prototypical picks and shovels company. But yeah, I mean, I think I was previously at a fintech and insurtech fund, and ultimately, and just as we saw with old technology of credit bureaus moving into sort of new tech with a ton of data, using a bunch of machine learning. So, insurance using usage-based insurance, or life insurance with a weight scale, if you can run a 6-minute mile or under. Before, there was this old way to reach customers using direct mail and branches. Now you have all this changing consumer behavior, banks being unbundled. And so we think fintech will continue to just be a really strong place to invest. And not just in the Valley. I think what we've seen over the past 15 to 20 years in the US will certainly replicate all over the world. And I think it just bodes really well for the industry in general.
Sound like good opportunities. Well, in the last few minutes that we have here, what else should we cover that we haven't?
Yeah, I mean, I think if you're kind of going back to to your first question of how did I make my way into venture? Yeah, I mean, the only thing I would just say is venture is incredibly forgiving in terms of background. And there is, unlike something like private equity, where they're really looking for a target school, a 2+2, either banking or consulting program, and then you jump on that recruitment wheel. I mean, venture is incredibly open, and basically there's just no paved path where you're going to be a great investor. Lots of phenomenal operators don't become great VCs. Lots of great VCs don't necessarily need to be operators. It's really about just forming your own, just reading as much as you can, forming your own thoughts, and I kind of just hoping they're right. And the amount of luck, I would say, that just plays such an outsized role in these outcomes, and even just getting into the industry, and serendipity is basically everything. And I guess the only thing I just want to say is that it's basically, anyone can do this job. Not anyone can do it well. I'm a walking example of that. But I think if you do, I'm always happy to sort of share my experience, because just I have a very different background. And while the industry venture has certainly a lot more to do in terms of increasing folks from underrepresented backgrounds, both socioeconomically, racially, and by gender, we're certainly, it's top of mind, front of mind, certainly for us here at Dreamers. And yeah, and just however I can be helpful.
Well, we appreciate you sharing your thoughts today. How best for listeners to get back in touch with you?
Yeah. So, my email is Vik, V-I-K, @dreamers.vc. Message me on LinkedIn, but email is likely the best way. And yeah, look forward to chatting.
We'll add those to the show notes. We want to thank you for joining us today and hope to have you back for a follow-up soon.
Perfect. Thanks a lot, Hal. Appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.